there, my beautiful people. It's your favorite auntie, Queen Marie.
Hey, beautiful people.
Hey there, beautiful people. Hey there, beautiful people.
Hello, beautiful people, and welcome to Tax Form Mastery. I'm Tamika Marie, and I'm here to guide you through the maze of Form 1040. Whether you're just starting out or looking to sharpen those tax prep skills, I've got you. We're keeping it real, simple, and clear. So let's crack the code on Form 1040 together. All right, so let's get into this. Form 1040 is the backbone of personal tax returns in the US. Think of it as the main dish at the tax party, and all the schedules lead back to 1040. So everything that you're going to do in a tax return is going to report on either page 1 or page 2 of 1040, and then everything else is going to be supporting forms, documentations, or worksheets, right? So everything else is pretty much just the sides, whether you're employed, freelancing, have investments, passive income. Form 1040 is where you report all that jazz to the IRS. Now, there are a few variations of Form 1040. So I want to make sure that you guys check out the printout that gives you the different forms of 1040 that there are, right? But we'll break that out later just so that you can be able to help your clients. There is going to be some additional informationals down over in the left-hand corner in the resources tab. All right, so the purpose of this course, I'm running through the 1040 and the 1040X. So you're going to have a part 1 and a part 2. And I'll probably dig a little bit deeper later and go over the NR, the SR, and the NREZ. But let's start with the big fuss over 1040 first. And I'll tell you the money, it basically tells the IRS your money story. It's your income, your deductions, your credits, you name it. How we process this form decides how you're getting a refund or if you're going to be writing a check. So understanding this form, knowing how to explain it to your clients is key to holding on to your expertise and establishing yourself as a brand authority. Okay, the skeleton of Form 1040 is broken down into 13 sections that include details such as taxpayer info, filing status, income deductions, all of which help to calculate and determine what you owe or what you're getting back. So keep in mind, just because it's not an actual number doesn't mean that it doesn't help in the calculations. For example, your filing status from single to head of household holds monetary repercussions. So you want to make sure that you are establishing people in the correct filing status as necessary. Making sure that all of this information is accurate, including the birthdays of both the main header, the spouse, if any, and any dependents are going to affect all of the credits. So it's basically making sure that how you show up and square up with the IRS at the end of the year is on point. So think of it as the main storyline of your client's financial series. Both you and your client will sign off on the info listed on this return. And it's important to note that although there are several forms that help make up the 1040, once your clients sign, you're liable for the information that's been included, meaning that you have to perform your due diligence. If you haven't taken our due diligence class, I'll go ahead and I'll post the link down in the comments for you guys to go ahead and review that, because due diligence is the tax pros way of making sure that all of the information that they compile to put into the 1040 and the supporting forms and schedules is accurate. Do we always have to see all of the information tangibly? Do we have to touch every single receipt? No. But do we have to take certain steps and ask questions to ensure that the information that we are taking responsibility for filing is true and correct? Yes. Nobody wants to get a due diligence audit. Nobody wants the IRS knocking on their door. So make sure that you perform your due diligence or be prepared to tussle with the OPR, which is something none of us really want to do. All right, so sections 1 through 3 are the heartbeat. Your client's personal info is first up. So it's simple, right? But it's definitely crucial. This is where the story of who they are and who they support begins on this form. You're going to need their name, address, social security number, filing status, and a date of birth. It sets the stage for the tax journey by clearly identifying who your client is and providing their dependent details as well. All of this information is cross-checked against the Social Security Administration, so it's essential that the client and the dependent info appears exactly as it shows up on their Social Security card. Otherwise, you're going to see rejects if you are electronically filing. And if anyone is filing over 10 tax returns in any year, then they have to have an EFIN and electronically file all of those tax returns unless there's an issue. For example, if there needs to be a paper file where someone has already claimed their dependent, and there are a few other situations in which a paper file would be necessary. All right, so let's talk about identifying those dependents. All right, so qualifying child or relative that entitles the taxpayer to claim tax benefits. And those benefits are exemptions, the child tax credit, education credits. The criteria is the relationship, the age, the residency, and the support. The only time that residency doesn't come into play is if there is a pre-existing agreement. But to be perfectly honest, anyone who has been preparing taxes for a while knows that generally the IRS will side with the person who has the primary custody unless the income test comes into play where someone makes more money and they also have the ability to be able to claim that child. But the IRS really doesn't give a hoot or get into to court orders. All right. So filing status has significant impact on taxes as it determines the tax rates, the standard deduction, and the eligibility for certain tax credits and deductions, right? So there are certain deductions and there's a higher withholding for people who are widowers. There is a higher withholding for people that are head of household. So sometimes there can be just a simple couple of $100 difference between single and head of household. Sometimes it can be $1,000 difference. Married filing jointly is a preferred status over married filing separately because it automatically disqualifies you from certain credits if you're going into the married filing separately. So you want to make sure that you take that all into consideration. So let's talk about single. This status applies to individuals who are unmarried, divorced, or legally separated according to state tax laws of the last day of the tax year and have no dependents. All right. Married filing jointly is the status that applies to couples who choose to file their taxes together. They combine their income and deductions on one tax return. If they're filing separately, this applies to couples who choose to file separate tax returns, and each spouse reports their own income and deductions on a separate return. One thing that a lot of new tax preparers skip over, however, is that just because they file separately, you still need the spouse's information. You're going to need their first and last name. You're going to need their social. You're going to need their birthday. And it's going to show up on the tax return as the alternative spouse so that the IRS can link both those tax returns. And this is extremely important in community property states. And you know what, guys, I've been thinking about doing some community property state classes. Oh, but the states, they trigger me just because they're so different and so vast. And I do not want to go down the rabbit hole of 50 states, but we'll talk about that later. All right. So head of household is for unmarried individuals who pay more than half of the cost of maintaining a home for themselves and a qualifying dependent, such as a child relative. Now, I get into tussles all the time, especially on social media, with people who get benefits, whether those benefits are TANF, Social Security, what are other Section 8, right? Just because that people receive those types of income subsidies does not mean that they do not qualify for head of household. What happens is we have to maintain if they paid more than half. Some people have Section 8 and they work. Some people have TANF and food stamps and they actually do work. So we have to, it's very important that as tax pros, we ask those due diligence questions and maintain that the person is actually bringing in additional income. Now, if that is their only source of income, unfortunately, they would not qualify for head of household status, which does reduce their standard reduction, but it does not mean that they do not qualify for earned income credit. Well, no, they wouldn't qualify for earned income. Let's back that up because TANF and all of that good stuff, that's not earned income, but they would still qualify for the child tax credit. So again, due diligence is extremely important. All right. And then qualifying widower with a dependent child, this status applies for people, and they can claim it for up to 2 years after their spouse's death if the taxpayer has a dependent child that meets certain other criteria. All right. So the choice of the filing status can impact several can have tax liability impacts. Tax rates. So different filing statuses have different tax brackets for rates. For example, the tax bracket for married couples filing jointly is usually wider than those for single filers, which can result in a lower overall tax rate for the couples. The standard deduction amount varies depending on the filing status, and married filing jointly typically have a higher standard deduction compared to single filers or married couples who choose to file separately. This can reduce their taxable income, resulting in a lower tax liability. So you have to keep in mind that when we're looking at these 1040s, there's a couple of things that we're looking for, right? We're looking for ways to reduce their tax liability, which is going to be, there's going to be standard deductions. Then you can also do itemized deductions. There's so many different ways for you to be able to save your client money before we even delve into the credits. So then let's talk about those really quick, right? So eligibility for tax credits and deductions. Filing statuses can also affect that eligibility for various tax credits and deductions. For example, some tax credits have income limits that vary by the filing status, and certain deductions may be limited or unavailable depending on the filing status chosen. All right. And then let's talk about AMT. Filing status can also impact whether a taxpayer is subject to the alternative minimum tax, which is a separate tax system with its own rules and rates designed to ensure that high income individuals pay a certain amount of their tax liability. All right, so show me the money. Let's talk about this section. 1A through Z is going to go over all of the income that is listed through our system when we're going through the 1040. So let's talk about the money. Your income, wages, salary, tips, you name it. If you made money, it's going to go here. It's all about transparency with the IRS. All employers in most banking institutions are mandated reporters for FinCEN. So underreporting your client's income will lead to hold codes and unnecessary headaches and untimely delays. And now you got people calling you a scammer because if your client can't locate all of its income, then it's time to regroup. Put a pin in it. File an extension if you need to. We know sometimes those income transcripts don't come out until May. It's better to be late than to be incorrect, right? Because then that counts against your due diligence. And it also creates a situation where the taxpayer is not going to be able to get their refund. It's going to hold up the status of their return. And it just has an overall unprofessional appeal to it, right? So all W-2s are for employment and they're reported on line 1A. Line 1B is household employee wages, but be prepared to back this up. Do not just put this information in, especially if you have TaxSlayer. I know the TaxSlayer only asks you like 2 questions when it comes to household preparers, right? So it seems like it's just such an easy fix for you to be able to enter that information and go on about your business. But they will come back. They can ask for additional information. And as a tax pro, that is something that you should have asked for to be able to prove to look at, right? Line C is unreported tip income, which is usually received in cash and not listed on a W-2 in boxes 1, 3, or 5. Now, line 1D on Form 1040 is related directly to Medicaid waiver payments. However, how and where to report or not report these payments can be found in the instructions for the 1040, which I've also included in the resources, and its relevant schedules. If such payments are excludable, the instructions will detail how to properly exclude them from your gross income, potentially affecting how you fill out your 1040 form, specifically around income reporting sections. I can go deeper into this, and I do go deeper into this in Tax Theory 101. So if you haven't taken our Tax Theory 101 course, it's something that you definitely want to dive into. All right. So moving right along, line 1E is pretty self-explanatory. This autofills from the employer reimbursement as income on dependent care. It's reported as code W in box 12. If you go on down to the resources, I actually have a handout that tells you all of the codes and what they mean for box 12 in case you were ever wondering, well, what does DD stand for? What does C stand for? All of that information are broken down. It's located in the resources, so take a look when you have a moment. But the same thing goes for 1F. For more details about the ABCs of box 12, check out the handout. It's definitely in the instructions for you. Alrighty, line G pulls from Form 8919. That's for when your job didn't take out Social Security and Medicare taxes from your wages, and you're treating yourself like you're self-employed when you're not. All right. Line 6 is where you calculate what you owe for those taxes. Multiply your wages from line 5 by 7.65%, which is basically a conglomeration of 6.2% for Social Security and 1.45% for Medicare. And that's how you find out what your taxes due. This form makes sure that you're on the books right as an employee, so you get your Social Security and Medicare benefits straight. So if that's part of your self-employment tax, it doesn't make a difference. If you're a W-2 employee, it comes out automatically. If you're self-employed, we still figure that information in. Now it shows up on your Schedule C in your self-employment in your self-employment tax calculations. They're going to make sure that they get their money off top. So just know that. All right. So line 1H includes all other income, and you add line 1I, and that's for service members who receive non-taxable combat pay while serving in our armed forces. And finally, line Z is the addition of the entire alphabet game. We add everything up. We list that information there. And then if you look down at the bottom, line 2A and 3A is light work, and it's included in our tax theory course. But let's move forward and jump into the next section. All right, so let's cut it down. Understanding passive income, lines 4A through 7. Passive income involves earnings from activities in which an individual is not actively involved. Common sources include rental property income, earnings from business activities in which the person does not materially participate. Reporting requirements on line 1040, lines 4A through 7 encompass various types of income, including IRA distributions, pensions, annuities, and more. While passive income is like rental income, or income in the form of a business which the taxpayer does not actively participate in, is typically reported on a Schedule E, supplemental loss and supplemental income and loss, and then summarized on the main form of 1040. Tax implications of passive income is subject to different tax rules compared to active income. Notably, losses from passive income can only offset income from other passive activities with limited exceptions, right? So you can't say, I am a partner in a business that I do not work in, and I took a loss. That cannot offset the income that from your W-2 to lower your tax liability. It cannot offset the business income that you participate in, such as if you sell t-shirts. It cannot offset any income from that to lower your tax liability also. So let's be very clear in that. Because a lot of people are like, hey, I took a loss in this business. I lost $100,000. Why do I still owe taxes? It can only affect and reduce other passive income. All right. So understanding these nuances is crucial for accurate tax reporting and maximizing potential tax benefits. But each line represents its own specific passive activity that can be tracked right back to the 1040. Alrighty, one of my favorites is the adjusted gross income. AGI is key in the US tax law. It represents an individual's total gross income minus specific deductions, often referred to as adjustments. I'm doing air quotes. These deductions can include contributions to retirement accounts, student loan interest, payments, educator expenses, and certain other expenses that are allowed by the Internal Revenue Service. AGI is calculated on line 11, and this is new. So keep in mind, if you've been filing taxes for a couple of years, AGI used to be on page 2. So we're moving on up in the game now, right? So it's on line 11, and it's used before applying the standard or itemized deductions before any personal exemptions are taken into account, which show up on line 12. It serves as a starting point for determining an individual's taxable income upon which income tax liability is calculated. AGI is important because it reflects the taxpayer's income after certain allowable deductions, giving a more accurate picture of their financial situation for tax purposes. It is used to determine eligibility for certain tax credits, deductions, and other tax-related benefits. So it's also used very, very often in corresponding governmental entities. For example, if you have children that are attending school, going to college, and or if you are taking advantage of that lifetime learning credit or enrolled in school yourself, higher learning, your AGI is something that's going to come up very often. All right. Taxable income is the portion of an individual's income that is subject to taxation by the government. It is calculated by subtracting allowable deductions, exemptions, and credits from an individual's adjusted gross income. After computing AGI, taxpayers can further reduce their taxable income through either taking the standard deduction or itemizing deductions depending upon which option is more beneficial for them. So as a tax pro, it's important for us to be able to run those numbers and let them know which scenario is more beneficial, which is going to help them more. So they can take the standard deduction if they don't itemize high enough, but if they do have more itemized deductions, then the standard deduction is not going to help them to reduce that tax liability. If it's necessary, then that's what we want to do. Also want to take into consideration sometimes reducing their income, their taxable liability reduces their income so much that it may knock them out of the running to be able to participate in certain credits. So run them both plausibly, see which one is best for your client, and make the recommendation accordingly, right? Additionally, taxpayers may qualify for certain credits, which can directly reduce their tax liability as well. It's important to note, and it's important to explain to your client that not all credits are refundable. People think credits and they automatically think, oh, money back. No, 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 no. Sometimes it just reduces that tax liability and it's not refundable. So therefore, it's not going to move the meter on that refund line or trigger a refund in some cases, right? It might just get them to a zero balance. So taxable income is crucial because it serves as the basis for calculating the amount of income tax owed to the government. The tax rate applies to taxable income, vary depending on the taxpayer's filing status. Remember that? Single, filing jointly, filing separately, head of household, etc., and their total taxable income amount. As taxable income increases, the tax rate typically increases as well, following a progressive tax system in many countries, including the US. We are a progressive tax system, if you did not know that. All right, so here is a quick breakdown for you to be able to look at tax deduction A versus tax credit A, right? So if you've got a tax deduction, taxable revenue at $50,000, the deduction amount is $10,000. So what it does is the taxable revenue now comes down to $40,000. The tax owed on a 20% tax rate would be $8,000. However, if it was a tax credit and the taxable revenue was $50,000, the credit amount is $10,000. So the tax liability is now $10,000. Tax owed, zero. Picking up what I'm putting down? Hope you guys are. All righty. So here's another form that kind of goes through what the standard deduction basis is, right? Single or head of household, if you're 65 plus, blind, or 65 and blind, you're going to run between $1,650 up to $3,000, right? To $3,300. A widower and or married, you're going to run between $1,300 to $5,200. So you just want to take in those standard deduction rates. They're going to vary by age, blindness, and filing status. Alrighty, itemized deductions are expenses that taxpayers can claim on their tax return to reduce their taxable income. These deductions are listed individually on Schedule A, Form 1040, which leads back to Form 1040, and are reported on the taxpayer's federal income. Itemized deductions are an alternative to taking the standard deduction, which we just saw, and taxpayers can choose to claim whichever method provides them with the greatest tax benefit. So that's totally up to the tax pro's professional recommendation to the taxpayer. All righty, so deduction overview. Line 12, taxpayers choose between taking the standard deduction, which is a fixed amount based on your filing status that reduces your taxable income, or itemizing deductions if it results in a greater reduction. Itemized deductions include things like mortgage interest rate, state and local taxes, also known as SALT, charitable contributions, medical expenses, beyond certain thresholds. And then line 13 gets into the QBI, right? I love QBI. Some people are just like, anyway, it's reported on Form 8995 and 8995A. This line is for qualified business income deduction, also referred to as QBI, also referred to as Section 199A deduction. It allows eligible self-employed individuals, sole proprietors, and pass-through businesses, which we know LLCs are legal entities, not businesses. Fight your mama. And pass-through businesses to deduct up to 20% of their qualified business income, plus 20% of qualified real estate investment trusts, which are REIT dividends, and qualified publicly traded partnerships, PTP income. All right. So line 14 adds line 12 through 13. This is a simple calculation where you add the amounts from line 12 and 13. This total reflects your combined deductions, including either your standard or itemized deductions, plus any qualified business income deduction that you're eligible for. Alrighty. Now line 15 right here. This is where you're going to subtract line 14 from line 11. Your taxable income on this line is going to be subtracted from your total deductions. And this is how we arrive at your adjusted gross income reported earlier in the form to determine your taxable income. If the result is 0 or less, you enter 0, indicating that you have no taxable income. These lines are crucial for determining the amount of your taxable income. If it in turn affects their tax liability for the year, the QBI deduction on line 13 can significantly reduce taxable income for those who qualify, highlighting the importance of understanding what each one of these lines, credits, and deductions stand for. So if you need to rewind and go back and recap, take notes, keep in mind that we do have the ebook. You're going to have a questionnaire and some exercises down below. We're going to get you through this, but it's very important that you understand what each one of these lines represents, starting with 4A all the way down to 15. Okay. Alrighty. So we all talked about having a progressive tax system. The more you earn, the higher rate of tax that you're supposed to pay. Now, we all know that in the US, we are a capitalist society. So we're progressive in theory. But keep in mind that the middle class is who gets hit the hardest. And let me show you why. Alrighty. So bracket examples. We're going to have the 10, 12, and 22%, right? There's 24. It goes up a little bit higher, but it's very rare that people actually get into that. And again, it's the upper middle class, hardly ever the really rich, right? So here are the bracket examples. So the amount taxed on 9,950, right? Amount taxed at 12%. Anything over that 9,951 all the way up to 40,525 is going to be taxed at 12%. Anything over 40,526 is tapped at 22%. And then that's going to cap out at 86,363, and that's capped at 24%. If you're going over $95,000, this is what I mean when I say the upper middle class, then you're going to be taxed in the next tax bracket. Tax planning is so essential once you get into this tax bracket because we lose our shirts. Us as tax pros, we know that the goal is to break that 6-figure ceiling, right? That's where we first want to make sure that's how we know that we've successed it, right? If you look at any advertising for us to become tax pros, it's all advertising 6-figure this, 6-figure that. Well, you got to plan for that tax bracket, baby, because what you will learn if you are just a tax pro, or what you do know if you are an ERO, is that just because you make that money doesn't mean it sits there. If you're running a successful tax business, you're paying for your client loans, you're paying for the tax pros that are working under you, you're paying software, overhead costs, all of that eats into it. So making sure that you have a solid tax plan and also offering a tax planning upgrade to your clientele is so essential to your business. And that's one of the tricks and the keys of being able to operate year round. Alrighty, so tax credits, the non-refundable versus the refundable. All right, so non-refundable tax credits can reduce the tax owed to 0, but it will not trigger any movement on the meter for you to get any money back. Refundable credits can reduce the tax owed to below 0, and it can also trigger a refund. Key examples are the American Opportunity Credit, which is partially refundable, to the Earned Income Tax Credit, which is refundable. All right. One good one, and I've actually got a class coming out against this. You guys are going to see it really soon, is the solar tax. Solar tax is not the solar tax credit is not refundable. It will not trigger a refund for you. So if you're low income, if your client is low income and they purchase solar panels, it's not going to help them. They're not going to see any type of deduction. Solar credits are for high income earners, which is good for tax. It's a good portion of a tax plan. It can be, right? But a lot of these solar guys are so predatory, it's just ridiculous. If someone is making $50,000, they're not going to get a $20,000 credit. You know what I mean, on their taxes for having solar. It's just not plausible. There's nowhere for the credit to be able to be applied because they don't have the type of tax liability that would benefit from that. All right. Tax credits and payments is the calculation game. I'm running my hands together like Birdman over here. Now the math party begins. Calculating your tax and factoring in credits and figuring out payments or refunds. It's like a puzzle, and I'll show you how to put together the pieces. So line 16, the tax amount. Here's where you jot down your tax based on your taxable income. If you've got income for specific forms, like 8814 for kid investments, 4972 for special rules or lump sum distributions, you're going to mark that here. Line 17, Schedule 2, right? Line 3 is the amount that you pull from Schedule 2 from line 3. This includes additional taxes owed outside of the standard income tax. All right. So line 18 is a total of line 16 and 17. You're going to add up the line from 16 and any extra from 17 to get the total tax before the credits. Line 19 is credits for kids or other dependents. If you qualify for the child tax credit or credit for other dependents, which is the ODC, it goes here. And this pulls from Schedule 88112. Line 20 pulls from Schedule 3. Line 8, the amount. So this is where you add any credits from Schedule 3, Line 8, which could include education credits, retirement saving contribution credits, and more. So go and take a look at Schedule 3, which is included down there in the resources, and you'll be able to see what I'm speaking about. And then line 21, total credits. You're going to combine credits from line 19 and 20. Line 22, tax after credits. You're going to subtract your total credits from line 21 from your total tax from line 18. And if it's 0 or less, then you're just going to write 0. You owe nothing, right? Your tax liability is 0. Line 23, other taxes. Here include any other taxes you owe, like self-employment tax from Schedule 2, line 21. Line 24, total tax. Add up all of the amounts from line 22 and any other taxes from line 23. And this figure is what you're responsible for paying to Uncle Sam, right? So just because you don't have a taxable liability, excuse me, just because you don't have a taxable liability from line 22 doesn't mean that you don't owe taxes just yet, because again, self-employment tax, they're going to take their money off the top. There's no avoiding it, all right? Well, no, clergy and notaries. There you go. This breakdown should give you a clear picture of your tax situation from calculating your tax and figuring out what you owe, your taxable liability. Alrighty, so schedules 1, 2, and 3 are the supporting cast. Let's meet them. They add detail to your story from the extra income to additional taxes and credits, and they're the spice to the tax dish. So the 1040 used to be long, drawn out, and extensive. And what we did now is we have actually condensed the hell out of these things, and we have added additional schedules that help us to paint the picture and tell the story of exactly what your tax picture is. So, like I was just saying, changes in the tax game. Tax laws are like fashion, it's always changing. And I'll highlight the latest so that you can file with confidence and knowing that you're up to speed on what's out and what's new. But this pretty much brings us to a closure on our 1040. I always try to go back and tweak these. So keep in mind, this is what our current 1040 looks like. We're at the top of we're at the end of the season of 2023. So we're at the end we're coming up on April for 2024. What we want to see is if this 1040 is going to be changing. Now, I don't think it's going to change again until 2025 when we're going to have some of the TCJA repealed. So this should remain accurate and hold up for the next tax year. But this is going to bring us to a closure of our Form 1040. Once you've explained each line item, it's important for you to triple check the routing numbers and the account number on the return to verify any amount that's owed or due, and to have your taxpayers sign off on everything. I just had an issue recently with a client who provided me with a short account number, and it turned their refund into a check, totally out of our hands. But again, make sure your client signs off on everything, because unfortunately, sometimes when things get messed up, whether it's your fault or not, they're always going to be looking at you as the professional, right? Also ensure that your pay preparer details are listed correctly below, because not signing a return will result in penalties and fees. All right, so essential tax documents. All right, so W-2s for the employed, 1099s for freelancers, interest statements. For deductions, you're going to want to see receipts for charitable donations. Yes, you do have to look at those. 1098 for mortgage interest. Yes, you have to see that. And tuition statements. Those are mandatory. We can't skip them, part of the due diligence. And organization is key. Make sure that you're uploading all of the information so that it's being retained and you can always revert back to it. There's a 3-year minimum period for the IRS. I like to hold them for 5. All right. So we always try to highlight the latest. This course structure is designed to bring you to be the most accessible so that you can confidently navigate and explain to your clients exactly what a 1040 is. If you need further assistance, you like to schedule a one-on-one, if you want a discovery, I'll go ahead and link that information down at the bottom. You're always welcome to reach out to me. If you have any questions or comments, definitely put those below. You can select them so that they're public so that other people can see and get those answers when we do respond to them. Or you can set it up so that it just comes directly to me and my team directly. We answer all questions. We love to hear them from you. Sometimes we'll go back and we'll incorporate that information directly into courses when we update and revamp them. So do not hide for that. If you are not a member of our Link Up Forum, go and join it now. There are courses that I release that are specifically that go directly into the Link Up Forum live that I do not share in the Facebook group, that I do not share anywhere else. And some of them are not available for purchase. They're just for the Link Up Forum. That forum is $29.95 currently for a limited time. Again, this is the top of 2024. So that changes from quarter to quarter as we continue to add more value. All right. So, ladies and gentlemen, I'd like to express my heartfelt gratitude for your unwavering attention and your active participation in this engagement. It was thoughtful. I would love to have any questions that I can come back and definitely answer for you guys. And should you have any further inquiries or require any additional information, or if you'd like to take a consultation on how to implement these best practices in the industry, please do not hesitate to reach out to us. There's a button below for you to be able to book. I am definitely here to assist you and provide support. Once again, thank you for being a part of this course, and I look forward to many future interactions with you all.